So let's start with a explainer, if you will, at first. What's the difference between a binary option and the standard garden variety option? What advantages do they offer?
With binary options, they're a little bit of a simpler contract, a little easier to understand. Basically, they're binary because at expiration, they either settle at 0 or 100, and price could be thought of as reflecting the probability of where the market's going to go. So for instance, if I see a binary priced at 20, essentially the market's telling me there's a 20% chance of that event happening, as opposed to traditional options, which can be very intimidating when you start looking at probabilities and the Black-Scholes and all of the Greeks involved. Binary options offer a simpler way to express your opinion about what the market may do.
And why does it make sense to use these options now when volatility is low?
That's exactly a perfect time to use them. Oftentimes traders are looking for that opportunity, but if the markets aren't moving, a traditional option, it's kind of tough for either side, whether you're the buyer or the writer, in that you might be able to buy a cheap option. If you're the writer, you're not getting much premium, but also on the buy side, it's just not moving. So it's kind of like not much happening there. On a binary option, by their very nature, because it's 0 or 100 at expiration, if we have an at-the-money binary option going into expiration, we can see pretty extreme movement in that option, meaning because the difference between 0.1 tick in a traditional option is just that, 0.1 tick if you have a 1 delta. In a binary, it could be exponential. It could change the value 4 or 5 times.
All right, let's actually walk through an example here. Dow is trading around 17,000. You think the rally has some legs. So let's say you buy binary contracts that the index closes above 17,200. How does that play out if it does hit at the close and if it doesn't?
Well, if you're buying the 17.2 strike, if the market's at 1,700, depends on the time, how much time is left, but it might be trading, let's say, at around a 15. What that means is per contract, I'd put up $15, my worst case being 0. If the market closes over 17.2, it would be priced at 100. If it doesn't, it settles at 0. Now, you don't have to hold them till expiration, though. So let's say on the first day we get a rally up to just over 17.2. That contract that we bought at 15 may be priced around a 50 or a 55, and so we could close it out early to take our profit. Additionally, if we were wrong on the first day and the market dropped against us, we're never stopped out. 0 is our worst case scenario, so we're essentially buying time to be right.